Well, the Russell 2000 set to snap its 5-day winning streak. The small cap index slipping today after climbing almost 10% over the past 5 trading sessions. In that time, it has outperformed the S&P 500 and the S&P equal weight since July 10th. But with so many names in the small cap index, we're looking at how to navigate the trade with the Yahoo Finance playbook. And we're joined by Sandy Villere, Villere Company portfolio manager. Sandy, it's good to see you here. So first of all, let's just talk broadly about the small caps, the rotation we've seen in. Do you think it's justified, and do you think it's going to continue? And do you think people should be buying small caps as a group?
Yep. Yeah. Sorry. Yeah. So I'm very excited about small caps, and I think they've had a little bit of a, just incredible run. And I think it's basically just as a small cap investor, it's just been so lonely out there, just waiting for, tech to maybe pull back a little bit or what have you. And so, and we're finally seeing, and it all started with the inflation print, right? Once inflation was a little bit cooler than expected, and people expecting the Fed to cut in September, which looks like a foregone conclusion, then small cap finally caught a bid. And in my mind, the small caps are so much cheaper, trading about 14.5 times earnings. When you look at the S&P 500 at 25 times earnings, it just felt like it was time to have an opportunity to move into small caps. So we're very excited about the backdrop and think there's better days ahead for small cap even after these rallies.
Sandy, I'm curious, just broadly, when you look at small caps, what does earnings growth look like?
Yeah, so we're expecting robust earnings growth, right? And even when rates go down, right? Even if you're looking at 14.5 times earnings, remember when rates go down and there's a lot of leverage that small caps use. So I think the earnings are actually going to be even better than what are currently modeled into those forecasts. So I think small caps have an incredible tailwind behind them and a great opportunity to get involved again, even after the rally we've seen today.
Just to push back against this a little bit, Sandy, there are some skeptics about small caps. One of them is Eric Johnston over at Cantor Fitzgerald, and he was looking at the longer-term profit margins of the Russell 2000. That's the chart we're looking at here. The red line is the 10-year average. He says we're kind of bumping along that 10-year average here at a time when valuations are relatively elevated. I know you were just talking about relative valuations as well. Meantime, Savita Subramanian over at Bank of America has said that if you look at about a third of the members of the Russell 2000, they don't make money, right? There's a lot of money losers in there. So how do you kind of think about that if you're going all in on them as a group?
Yeah, and there is a lot of exposure to biotech and companies that don't make money. So that's a hard metric to sort of look at. But again, in this backdrop, if you just look at, when the Fed lowers 12 months after the first cut, small caps have outperformed large by about 11 or 12%. And that's going back, since the 1950 or something like that. So it just looks like the setup is good. They've really been left for dead, not only over the last year, but over the last 3 and 5 years with the Mag 7 just basically, in control of almost all the returns. So it's nice to see a shift. And I think that shift continues.
And Sandy, let's get into some picks here. One, I know you like First Hawaiian, ticker FHB. It's up about 8%, looks like, this year, Sandy. Why do you like that name?
Yeah, this is a very stable business. So, this bank was started in 1858, to give you an idea, largest bank in Hawaii. While we wait, we get a 4.5% dividend yield. The depositors themselves are extremely loyal to the island versus the mainland, and so their cost of funds are much cheaper than their peers. I just think it's a very inexpensive bank that nobody's really cared about, and I think it's got an opportunity to make 15 or 20% when you include that dividend yield without a lot of risk to it. So we like First Hawaiian.
This next one that you like is probably better known to consumers right now, talking about ONON Holdings, the shoe company, the upstart shoe company that's really roared higher over the past few years. The market cap here is $12 billion. And I have to admit, Sandy, I guess I thought of small caps as being smaller than this, but $12 billion, it does fit into that category. So where do you think the trajectory looks like for this one?
Yeah, it's got a lot of momentum. One of the most premium, shoe brands right now. Nike certainly struggled, and I think when I want exposure to the consumer, you probably want to get it through, Walmart, Amazon, or Costco. But otherwise, I want to be exposed to the high, kind of that higher end consumer that isn't going to blink, when they go to spend money on a premium brand like On Cloud. And, they're going to have a lot of exposure at the Paris Olympics, and I think that's going to help them out. It's not inexpensive. You're trading at 23 times enterprise value to EBITDA. Now, it was a small cap when it went public, 2021, but it's had a lot of growth. The retail stores are going to be good. They've got, maybe 20 in China, 10 in the US and Europe. And I think that is going to be ultimately 10% of their revenue. So a lot of growth ahead. And I think they're still in the second inning probably of what this shoe company will be.
And Sandy, another one here, Option Care, ticker OPCH. Stock it's in the red this year and over the last 12 months, Sandy, but you clearly see better times ahead here.
Yeah, I mean, this is really the largest independent provider of just home, therapy treatments. So when somebody's going to get an IV, they're going to get it done at their home. They can also get it done in a clinic. But I think when you just follow the money, the insurance companies love this because it's cheaper for people to get, their an IV in their arm, let's say at home or in one of their clinics versus the hospital. And obviously the consumer loves or would rather be at home than going to battle a big hospital. So they had a small, I'd say a little bit of a shadow on top of them, I would argue, with one of their division called Change Healthcare that was part of United Healthcare that was actually had a cyber attack. So they had about 50% of their claims that they were struggling with. That's all lapping. That's all coming through. So I think when they start to report, things are going to be much more, clear for them. The stock is cheap, especially when you look at multiples on either takeout or anything else. And so I like this one a lot. It's been left for dead, and I can see it. I see 28 to 30% upside over the next 6 to 12 months, frankly.
Sandy, great having you on the show today. Thanks for your time and for those picks. Appreciate it.
Thank you. Appreciate it.